You're listening to the greatest multifamily investment advice show. My name is Adam Ross, and now I'm talking everything multifamily for an in-depth conversation, and I will be diving deep into raising capital, deals, and underwriting process. Welcome back to the greatest multifamily advice show. Today we have Mark Baltazar, an exceptional guest and real estate investor out of Toronto region of Ontario, focused on multifamily, raising capital and land development and all sorts of fun. How are you, Mark?
Good, Adam. Thanks for having me on. Yeah, excited to chat about it, especially kind of your interest in why people are leaving Ontario, and I'm still here.
Yeah, thanks so much for being today, and I appreciate you taking the time.
Yeah, of course. I love chatting about this kind of type of stuff. Yeah, I mean, I think there's more and more interest in commercial. Well, I don't know if in general if there's more and more interest. I mean, I think what happens is, as people invest in residential types of projects, they eventually either reach a plateau or they're leveling up. It's kind of time to kind of grow themselves as an investor, and so you see more people kind of moving into commercial, and they do it for different reasons. So yeah, I love chatting about it. The beauty about commercial real estate, or just real estate in general, is that there's an approach for everybody, right? So it's super flexible. There's so many different types of strategies, multifamily, retail, office, industrial, self-storage, there's so many paths to go. So
from the beginning, I think you were in the marketing side and you switched to real estate. What was the motivation? Like, what happened was an actual trigger point for you?
Yeah, I love that. So I was a partner in a brand research consulting firm, which was really cool. I mean, it was for 15 years. I worked in that type of industry for almost 20 years, and then 15 years as part of this boutique research firm. And we did some really cool projects, some really cool companies in North America and around the world. I got to travel, which was fun. And I loved it. Like, I loved doing that. Being part of a consulting firm, it's very human resource heavy. And as a partner, that required a lot of my time, especially dealing with some of these larger clients and travel. And so, while that business was growing, my family was starting, young kids. And I was just finding more and more that I was, missing the, those important moments, as our kids were growing up, and, getting questions from my kids, consistent questions about, "Hey, Dad, you going to be home for dinner tonight?" And consistently it was, not tonight. And that took a toll on me, because I felt like I was missing out a lot. So, and again, this didn't happen overnight. I looked at, what are other options to generate income, but also grow wealth beyond this type of business. And people are successful in the consulting business and scaling it and not spending as much time. I didn't do that. And so real estate was always on the list for my wife and I to figure out rental properties. My family had a couple. My parents had a duplex. My grandparents rented their house in Toronto, so it was always it wasn't front and center, but it was there was kind of inklings of this idea that eventually percolated. So I started while I was at I had the consulting firm. Started with a couple flips a year. I think one flip a year, then two, then three, and then ended up doing close to 30. Not on my own. I had partners. I had tradespeople that were kind of doing that. So it was taking up a little bit more time, and I liked where it was going. It provided a lot of flexibility. So in that was 2000, let's say 15, where I did my first investment deal. Yeah, it was a flip. Held a few properties, and then I'd say probably 2016 started studying and trying to understand commercial and multifamily specifically, and then made the I wouldn't say made the switch completely, but transitioned into commercial in 2017.
Yeah. But your approach is, you said you took some time for studying. Back to 2016, Toronto was still, I'm not going to say affordable, but it was not like right now. So what was motivation for Toronto, especially? Because you started multifamily in Toronto when everyone is looking for better cash flow, cash on cash,
Yeah.
return on investment. So why Toronto?
Yeah. So, okay. So just to be clear, so I don't have anything in Toronto proper.
Yeah.
I'm in the GTA. So I have, properties in Hamilton, Barrie, Kitchener.
Okay.
Our most recent deal that we have under contract is in Mississauga.
Yes.
Not in Toronto proper, although we recently did look at it. Yeah. So GTA, GTA and surrounding. But you're right. A lot of people are moving out. I wouldn't say a lot of people. There are people moving out into other provinces. And I think you mentioned the reason why: cash on cash return.
Yeah.
So for those, and so I didn't really need cash on cash return. I still had an income, from my other business. And so I didn't need cash on cash. My strategy, and the reason why, what real estate needed to do for me, and I think that's a question that everyone needs to ask themselves, and it is, what does real estate need to do for you? And everyone's going to have a different answer. For some people, it needs to be cash today. For some people, it needs to be wealth building, right?
100%.
And for some, it needs to be both, right? So for me, it was more about wealth building versus income generation today. And because of that, the GTA market, or GTA and surrounding areas, the Ontario market, let's say Southern Ontario market, provides a wealth building platform. Some properties cash flow. I do have buildings that do cash flow, right? So cash flow, it's not that it's non-existent. Yeah, it might be harder to do, but the ROIs are just as good, if not better, actually. So if you are in the equity building game and in the wealth building game, then this market is still very good for you. If you're looking to,
because you're focusing on the appreciation, on the actual general idea, it's more appreciated than any other market.
Yeah, I mean, you're at this, let's say in Canada, the biggest markets in Canada, right? And if you go back to what are the drivers of this business, like what makes a rental business successful, it's people and population. So where there's population growth, where there's business investment, where there's transit, where there's GDP growth, where there's immigration, that's where you want to be. And so those are the markets that I'm in. Now, if you want cash flow, like more cash flow, then you might have to go to other markets, maybe smaller markets. Your cap rates are higher, but again, remember, higher cap rates means slightly higher risk, right? So yes, it's cash flowing, but is the economy
occupancy?
stable?
You mean occupancy rate? The occupancy rate of this market is going to be lower than Ontario, of course.
It could be. It could be. Now, just also to be clear, we're buying properties that are not cash flowing because we're purposely buying properties that are underperforming. They end up cash flowing once we stabilize it, right? So
this was basically my next question. What is your target market and criteria?
So the target market. So basically, again, in these areas, like, I get sent deals that in smaller markets. If it doesn't have 100,000 people or more, then it's not really of interest to me, because to me, where there's people, that provides a protective layer around your investment, because those are your customers, right? So like any business, if you're starting a business, you want to be in a location or market to a target market where there's a lot of people versus fewer people. So that's the criteria, is markets of 100,000 plus, good transit, good business environment. The municipality is attracting businesses. They have a good plan for growth. Immigrants go to that market. And so again, it's if you think of commercial real estate or multifamily as a business, where are customers coming and where are they going to come in the future? You want to be there. It's like Walmart. Walmart, when they were developing in the early days, what they would do is and they still do this to some degree, is they would buy locations ahead of urban sprawl. And so, they would plant their locations knowing that within a year or two, or maybe 3, they'd be surrounded by households, right? Population. And so ours is maybe not exactly as the Walmart strategy. We're buying in markets that already have population, and will continue to grow. So typically, just in terms of the cash flow piece, typically after 18 months, once we've stabilized the building, it cash flows. So it does end up cash flowing. So then you have cash flow and strong equity appreciation. It just takes some time to get there.
So when you're selecting a deal for your underwriting process, let's say you're checking the proposed next 5 years of performance, what is cap on cap percentage usually you go? And you mentioned that you're focusing on having this transition from low cap rate, adding value, and then change the cap rate for a higher cap rate. So what is your magic number when you're saying, okay, this is my minimum cash on cash percentage or cap rate for a property you're doing underwriting for? Because there's a lot of deals on the market, on different markets, but not all of the deal is going to make you
100%.
as you said, touching your target basically.
Yeah. So very good question. So one of the things, because again, for myself, as well as, so I have, buildings that myself and my business partner own on our own, as well as we have apartment buildings where we bring in passive accredited investors. Typically or I'd say, 99% of the accredited investors that work with us, they have other businesses, they have high paying jobs. They're not really looking for cash flow today. That's not really their game. Yeah. They're not really, pulling line of credit to invest in these types of projects. They have capital that they need to deploy.
Just sorry to interrupt, just for the listeners about the accredited investors in Canada and US, accredited investor equal to per household 340,000 income per year, for individual 200,000, or to have more than $1 million equity cash equity on the individual assets. So sorry to interrupt, but just to differentiate between the terms of accredited investor, because it's not familiar to regular newbies.
Yeah. No, that's a good point. The other thing is to a net worth of $5 million. Yeah. Right. So assets minus liabilities.
Yeah.
So I'm gonna answer your question about what our target is afterwards. So knowing that a lot of our projects are really for equity building, the cash flow target is anywhere from 4 to 6% cash on cash once it's turned over. Okay. And so when you look at that, it's a pretty healthy cash flow in this market. The other thing that we look at as we're underwriting is typically we put long-term CMHC insured debt on these projects. So we need to make sure that at the end of our stabilization process, so the time it takes to from acquisition to turning the business around essentially and generating more income, that it needs to debt service with CMHC. So before March 2022, we had to refinance and ensure that the income was high enough to support a 1.3 debt coverage ratio, right? So meaning that your income has to be larger than your debt service. So your net income has to be net operating income has to be larger than your debt servicing by 1.3 times.
Yeah.
Now so interest rates are going up, right? That's they've gone up, and so now
it's a challenge.
It is a challenge.
Yeah.
It is a challenge, and so wherever there's a challenge, you got to find a solution. So the solution that we have right now, and the timing of this from CMHC was pretty good, is that they've launched a new program called the MLI Select program, which which basically rewards operators in terms of more favorable financing if they do certain things, right? So improve energy efficiency, improve the accessibility of the unit, as well as potentially provide affordable housing. So you can do any one of those things and you get points and such, and that's a whole discussion. But basically, if you hit their targets, you can now get financed at a 1.1 a debt coverage ratio. Right.
Wow.
So that helps. Yeah. So that helps with cash flow even more.
Yeah.
But now with interest rates going up and with this lower debt coverage ratio, it almost offsets itself. Right. So again, back to your question, what is our target? Our target is to ensure that we can refinance with CMHC and hit their debt coverage ratios.
To be honest, this is an actual interesting subject because I see that all of the current market is like going to private lending, but you're doing something different, which is really hard to qualify for CHMC like policy, basically. So is this because your targeted market where is an actual stability and you can easily hit the target of high rent, so you can potentially meet with CHMC rules? Because I never hear it's this easy to meet with the rules, especially that. Yeah, this is for me a new information about the 1.1. I didn't know about it, about the energy efficient, but I think this is helping you because potentially you're getting the actual loan with little bit less interest. So potentially it's going to help you on the overall cash flowing on this specific market where everything is going to be hard for you to qualify.
Yeah. So, I mean, so how do I put it? So anyone can qualify for CMHC. If you want to put more money down, right? If you want to put more money down on a property, like CMHC is just insuring the mortgage, right? So
yeah,
you can now versus private, to your point, versus like private financing, their loan to value is going to be a little bit less, right? So you typically do have to come up with more money in order to purchase, through CMHC. Their underwriting is a little more conservative. So there's a whole bunch of things like that.
Yeah.
But that our goal is to get the income, and we've done this now a few times, is to get the income levels high enough, or the net operating income levels high enough that we can refinance with CMHC, qualify for a good debt coverage, their debt coverage ratio criteria, take out all of the debt that was used to purchase it, sometimes be able to pay some of our investors back some capital, and then basically run a cash flowing asset, for, at least 5 years or more, depending on the project.
I think the challenge here is, based on what you're saying, is raising capital, because as you said, you need more loan to value to get qualified, because you're not leveraging as much as you can because the rules of the CHMC versus high interest rate with hard money and higher LTV, correct?
Yeah. So the benefits, it's a trade-off, right? And this, this conversation I literally have pretty much every day. My business partner and I, when we're looking at deals, it's always about financing makes or break a deal. What strategy, what financing strategy are we going to apply? Think about, as an investor, you have to have, like, quote unquote, a financing toolbox, right? And there's a bunch of different strategies, right? And, there's CMHC, there's private, there's using seconds, there's raising equity, there's construction financing. So there's a whole bunch of different ways to do things. And, for investors getting into the space, or even the seasoned investors know this, you have to have some knowledge of all of the available ways to finance things. If you don't have it, that's okay. You can work with a broker that has that experience, right? So step one is understanding what the financing toolbox looks like. And then on each deal, it's looking at what is the right combination of financing strategies, because sometimes it's multiple strategies in one deal, what's the combination of financing strategies that's going to make this deal work? Going back to your point about private, yeah, you can buy buildings with private financing, very high loan to value. So meaning high leverage, right? 85, 90% leverage, but you're paying for it, right?
100%.
So the interest rate's higher. I mean, it's definitely something that you don't want to hold for a long time. Like we've done that in our stabilization period, but it's a very short amount of time, 12 months, 18 months, right? And there's a clear exit strategy for that, that private debt. But you don't want to hold it for very long, right? Because it costs a lot.
Yeah.
And also it's interest only. So there's no principal pay down on this either. So you're not benefiting from principal pay down. You're just paying interest.
100%. So how much was this like percentage wise for your private lending? I think you used it on the beginning when you needed a little bit higher LTV, because the raising capital on the beginning for everyone is not easy.
Yeah, it ranges, right? So I think, when I first started, it was above 6.5, right? As you start to work with lenders and they get to know you, they get to, know your strategy. They're comfortable with you. They've done multiple deals. That starts coming down. Also, as the loan amounts go up, the rates come down, right? So, we're at probably 5.2 right now. 4.8 we were quoted the other day for one of our buildings, which we're still trying to kind of work on the financing strategy there. So you're looking at anywhere, I would say, to be safe, look at 5.5 to 6.5. If you can do your underwriting on those numbers and it works, then you should be able to get, capital at that cost. So yeah, I mean, that's what I would do. That's what I would budget.
But what was CHMC right now interest rate for you? Of course, it's going to be lower.
Yeah. CMHC. Okay. So CMHC right now, on one of the buildings that we're looking at right now, they are at about, they're under 4. So it's under 4. Again, interest rates have gone up now. Like, I'm not 100%. Sure when this is going to be released, but we've already had a few increases and another one coming, probably June 1st. Right. So they're at 3.9, 3.75 or so.
So almost 2% different between the private money and CHMC, but it's going to help you a lot on the cash flow and all of your expectations. So how many units under management so far?
I would say, I don't know the exact, probably 120.
That's good.
Yeah, maybe a little bit more. I mean, there's 120, and then we're in adding units. We're adding about about 10, 12 units. So it's like 120, and then we'll have hopefully 132 with these other units. And then we have a few other buildings under contract, another building under contract was it. So by the end of the year, it'll be like 150, I would say, close to 50 million under management.
So what was the transition, how you started to grow? I think you said you did a little bit like a 30 flip and then the regular transition to multifamily, 20 units, 30 units. And then, so how was the journey, like timeline?
Timeline, I think so. 2017 was my first buildings. 2017. So yeah, I mean, it's been 5. No, sorry. That was 2018. So yeah, I mean, it's, I guess 4 years or so to get there. I mean, the first year was just, 2 buildings. And then I can't remember, maybe the year after was like nothing. Right. And then we really ramped up, because it became more of a focus. So early on, it was just, let's put, a building in the portfolio and kind of just run it. Still doing flips. I was still at that time had my other business. And so it wasn't 100% of my focus. And then I guess late 2019, then it became 100% of, so this is what I do full time, 100% of focus. And then, like anything, like where your focus goes, your energy flows, and it's, absolutely true. That's been a focus, and we've been able to scale the portfolio to, we're already over 40 million, but we'll be, I think we'll be 50 million by the end of the year.
Great. So what was your criteria to manage raising capital? Because as you said, you started in 2019 and 18 on multifamily. I think the first issue was how I can start with raising money, get qualified, because the qualified investor is another story. So you started to, usually you start with family and friend, and then the next step is looking for qualified investors. So can you tell me how you started to do this? Like how you managed to have your system, and what is your system exactly?
So I think, yeah, I mean, okay. So go back to when my first few deals were funded, on my own. And then I think and the intent was really never to raise capital. But I think like everybody, or many in this business that are doing this, running real estate as a business, eventually you keep growing and you run out of your own money. But you still want to keep growing. Probably at the same time, others around you are noticing what's happening. And so for me, the way it worked is I funded my own deals. I don't know, maybe for the first year. At the same time, people, family and friends were asking questions. Hey, how, what are you doing? How do you do that? Is there a way for me to get involved? And it's like, oh yeah, sure. I mean, here, I'm not sure how, but let me think about it. Right. So because capital raising wasn't really front and center for me in the beginning, nor did I think that that's where it was going to end up. I didn't really have a system. So it was very ad hoc, right? JV partnerships started, right? I was a part of the real estate investment network early on, RAIN, actually right from even before I did my first deal, I was part of RAIN. So they taught, joint venture partnerships and such. So I had some idea of how it can work. Then after and this was a flip deal, doing a flip deal with other people's money or partnering with other people, it kind of, the light bulb went off. I was like, wow, this, I can really do this, run a business, and help other people generate money in real estate while not having to be involved in the projects as I was. And I think the mindset, and this again came to fruition even a week ago. I had lunch with an investor of mine that's been with me for probably the longest of all my investors, and it's now multiple millions of dollars with us today, and just over the course of years, many millions of dollars invested. And he's like, Mark, I'm so glad that I met you, because you're helping me. I know I'm helping you, but you're really helping me, make my capital work. So I think the big thing for capital raisers is that, and especially in the beginning, is that you have something to offer. You're doing a service for people. You're giving them an opportunity to make more money than they would in, other forms of investments. And so I think that light bulb went off, I think early on for me, that, hey, I don't need people's money, right? I'm giving people an opportunity to generate more capital. And I think that's a big mindset shift, and an important mindset shift that people need to make. Because I think in the beginning, new capital raisers may think like, oh, I don't want to feel needy. I don't want to ask for money, right? That's the wrong mindset. The mindset needs to be that you have something to offer people, and you're doing people a favor by investing with you, which is true, right? Like, or else what else would they be doing with their money?
Is you're not on the same level to understand all of the actual industry, and you're offering them this so they can grow their money with higher interest than banks, for example, or other 100%. Investments.
So that's kind of how capital raising started. And now, I mean, my background is marketing, so I understand, the concepts of marketing. So I put myself out there a little bit more on social media. Have had consistent marketing for a number of years, and people see what I'm doing and what the business is doing. I have a podcast, right? Just like you do. The podcast has been instrumental in that, in speaking to people I've never spoken to before. They already know how I operate, how I think, what my strategy is. So it does, those platforms like our webinars, we have a pretty good, webinar program. We do some coaching, we have podcasts. So, there's a lot of education that we put out into, the universe. And it's basically about the stuff that we do, like our process, our operation. So when investors come talk to us, they kind of already know what we're doing, right? So that we're not selling people on, investing with us. They already know what we're doing. And they, they've been following us for a few years already, perhaps, and they know how we operate. So I think that's the power of, pull marketing, right? Versus push marketing, where you're kind of pushing something onto somebody. We put our stuff out there, and, those that like it and can resonate with who we are as people and how we operate and just our value system, come to us. And those that we don't resonate with don't. So, that's at the end of the day, it's a pretty kind of straightforward concept, but that's what we're, that's our marketing system.
So I think this is the great approach of to be always there. Do not push yourself. People see what you do, the result, the record, and based on this, you can prove you're worthy on the market itself. So the challenge always is developing your relationship with different kind of stream to bring off-market deals. So tell me how you're doing it. Like, what is your approach to get off-market deals?
Yeah, so I think that it's a good question. And it's not always off-market deals, right? So I think there's this idea that only off-market deals are the best deals. So again, even the people that we coach that are getting into, apartment building investing for the first time, is any deal is a good deal as long as the numbers are right. It doesn't matter where it comes from. Now, yes, if it's on MLS, more eyes have been on it. Very true, right? But hey, listen, like if I look at, our portfolio right now, I wouldn't say half. I'd say maybe, I don't know, 40% were from MLS, right? So if it wasn't for MLS, we, 40% of our, we would have 40% less of our deals. So there's MLS deals, right? So I think don't discount MLS deals. Continue to look at, if the numbers work, the numbers work. At the end of the day, it's, financially, if it makes sense, then buy it. Then there's off market. So I think there's on market and off market. Off market is directly to seller, right? Or hasn't been, posted anywhere. But then there's deals that come from brokers that specialize in multifamily, right? Some consider that off market, some consider it on market, but typically it doesn't hit MLS, and it's circulated to those that are, I'd say, active buyers. And so you want to create relationships with these brokers, and there's a number of them, in, whichever market you're in, you will find them. Find them, introduce yourselves, have them understand what you're looking for, create a relationship with them. The one I would say, not caveat, but caution, is that when you're working with them and they send you deals, right, and you're not buying or closing, then you're not going to get access to those deals anymore. Yes. Right? So you want to be known as a closer. You want to be, now, it doesn't mean that you're going to buy everything. If you're not going to buy something, give them feedback as to why you're not buying, right? So they understand, why. Don't be a tire kicker, right? I talk about that a lot, right? Because there are some people that just want to see deals for the sake of seeing deals. And if that's the case, no problem. Just let people, the agent or the broker know that that's what you want to do. And then they can decide whether they share that deal with you or not. Yeah. If you position yourself as you're going to buy and then don't end up buying when you really should be buying, that could really
no one want a tire kicker.
Yeah, it's going to taint your brand, your brand, your personal brand, your reputation, and you don't want that to happen because it is a small industry.
Yeah, it is.
So on off market. I mean, off market, we've bought a few direct to seller. That takes work, that takes effort, that takes consistent marketing. We don't do that a ton, to be honest. Like our relationships are with these brokers.
So can you tell me about your largest deal so far? Where is this? Where is the market was? What was the numbers?
So with the what, sorry? Can you repeat
the largest deal? What
deal?
was your largest deal so far? What was the numbers, the market, the criteria? How you got the deal, MLS or off market?
Yeah. So, I mean, okay. So in terms of purchase,
Yeah.
so I'd say our highest value project right now is probably a Hamilton project. It's probably worth about 7 million.
Yeah.
Yeah, 7 million. It'll be worth more than that once we add a bunch of units to it. Purchase to date, 5.3 million in Barrie. Although no, we have one under contract right now. It's 6.4 million in Mississauga.
Oh, okay.
So that one, again, it's great project, excellent, like great location.
How many units?
18.
Okay, 5.3.
6.4.
6.4. Okay, and the cash flow on this one?
Oh no, not out of the gate. Again, 6 vacant units, low net operating income. So again, this like cookie cutter, every deal we get, this is the same thing, right? So again, we're very systematic what we're buying. We believe that there's a very strong opportunity to grow the net operating income beyond to what it is. The beauty about this deal is that there are 6 vacancies, maybe 7 right at close, which is unbelievable. Like if you're in this business, if you can turn over units fairly quickly, right, that is a big bonus in this type of model. And so the fact that we have 6 units that we're going to be renovating from day one is pretty significant. And that's what makes this deal really work. And so it will cash flow this is an 18 to 24 month stabilization process. At that point, yeah, this building will cash flow.
I think on this deal, you have 2 challenges. The first one is how you qualified with this vacancy units. And the second one is, the actual Ontario law with the rent control. So can you highlight how you dealt with the 2 points? Because, the rent control, you have 18 months for turning over or adding value, but you have to have a strategy to basically have access to the units, which is usually keys for key, money for key.
Yeah. So, okay. So the first question is, how do you qualify with vacant units? So typically a lender, and I think in all cases, in all deals that we financed, can't think of an exception, but even though it's vacant, the lender will kind of give you, will value the building based on what that unit can be rented out for as is. Okay. So for example, 6 units will be vacant, but the market rent, let's just say for number's sake, if we were to rent it as is, it'd be, I think those units are like about $1,600 per unit. Okay. So the lender is going to give you or assume in their underwriting that those units can generate $1,600. Okay. We know that we're not going to rent it as is. We're going to renovate. They'll take us, probably 30 to 45 days to renovate that unit. And then within a 4-month period, we'll have $2,200 per month coming out of those units. Right. So
just to interrupt, sorry to interrupt. This is private lending, not CHMC for the actual
so we don't do CMHC, and it's not really worth doing in my opinion, doing using CMHC insured mortgages until your income, your net operating income, has been optimized or close to optimized, meaning it's the max it can be for that building.
Yeah.
Then it makes sense. So we're buying this with it's institutional capital, so it is private institutional capital. The lender understands the strategy. They've financed deals like this before. They understand, they know us, they know our strategy. So they know that, those vacancies are really not a big risk for them. They understand what we're going to do, the timing that it takes to turn them over, renovate, re-rent them. Right. So it is important, I think, and your question is a good one because it brings up the point that and we stress this a lot with the people we work with in our coaching clients. You have to work with lenders that know the space and that understand the strategy and have done and have financed deals like this before, or brokers that have financed deals like this before.
Yeah.
Because if they know the strategy, then it's easy for them. They get it, right? If you have to convince the lender, about the strategy, there's gonna be a lot of questions. They might not know the end game. It can be done. It just takes a lot more effort, but also you might be paying more for it because they see risks in the process or the business plan because they're not used to it, right? So super important to work with brokers that that specializes this, and there's a number of them.
Just for me to understand, so what was the NOI, the existing and the actual predicted after adding the value?
Yeah, so on purchase we're about it's about 190,000 net operating income or so, about 92, maybe 192. In the end, once we're done, so this is a 5 to 7 year project. In the end, we'll be in the, I believe, close to 380. So we're doubling it. That's typically we're typically doubling net operating income.
So you're getting them with 7 million, and the goal is to have it with 13 or 12 million within 5-6 years.
Yep.
Yeah. Okay.
Yeah, it'll be like 11 to 12 million.
Yeah. So I think what was the upside about this one? Is it poorly management, or you notice any unusual maintenance issue during the actual underwriting? And how was the process for the underwriting for this building, especially in the Mississauga one? Any issues, environmental reports?
No. So from a building perspective, so we've done all those the due diligence. So phase 1 was clean. Building inspection report, a couple minor things. Older boiler. The windows we know need to be replaced. The benefit of doing those things is that it allows us to qualify for this CMHC MLI Select program because it's making the building more efficient. So nothing major from a structural standpoint. So again, this was, and this is typical of buildings that, like this, it's a family run building. Okay. It's a family member bought it. I think maybe 25 years ago, 30 years ago. Right. It's been in the family for that long. It's been passed on to, the children who are now, in their 50s. They each have families. So I believe it's 3 of them. They've operated as a side hustle, but not professionally. Right. So, rents aren't maximized. Yeah. They've kept up with maintenance, but the renovations aren't, at least to our standard, because when we renovated, we're doing condo quality renovations, and, that's what enables us to get higher rents. So, it was managed as a side thing, right? Poorly managed, maybe. I mean, definitely not optimized, like, for sure. And so, even some units don't have actual written leases and stuff like that. So again, there's, like any business, if you can buy a business, not even talking about buildings, but just business in general, something that hasn't been run optimally, and you can see there's an opportunity for you to implement your systems, your management, your process, and make it better. And that's how you profit, right? So that gap between where it is today and where it's at the optimal level is what's left on the table for someone that wants to take on that project. So again, this one, again, not professionally managed. There's room on the table. In contrast, we purchased a building last year that was professionally managed by a big REIT. And in fact, so we bought it and it was cash flowing out of the gate at purchase. Right. Now we've recently improved it, made it even better. It's cash flowing even more than it was before. But it gives you an idea of, like, when it's managed not by a professional, REIT, for example, or professional property investor, the difference in income is quite notable. So and it fits perfectly with our acquisition target. Like, it's actually kind of bullseye in terms of what we look for and buy.
Yeah, I think also yeah, as you mentioned, your goal is always to find this poorly management, because this is where is the actual pie is, like where you actually make money is in these deals when you can uh, bump the actual net operation income to generate money and do the refinance. This is basically the recent strategy for all of the multifamily investors. So my next question will be, your growth on even on the partnership. You started with regular GV partner, but right now you're leaning more to GPLP, correct? Because you're dealing with security law and qualified investors. So what was like what was the trigger to start dealing with qualified investors?
Um, well, I think, yeah, I mean, it's the law. It's the law. So first of all, I think it's, and we want to run our business properly, right? Like we want to run it above board. Like there's too much at stake there. Our investors put, our confidence in us, we want to do things right. And so we've invested to do that. So we have a securities lawyer that we've used now, that we've hired, in addition to a lawyer to run our transaction, like our real estate transactions, as well as to kind of put together our partnership agreement. So it takes investment, and allows us to sleep at night, ensures that we're doing things properly. And it's, I think if you're in the capital, I mean, our business isn't capital raising. Our business is operating apartment buildings. From time to time, we do have projects that accredited investors can participate in, but we just want to make sure that we're above board and doing things properly. And it's a big thing for us. There's a lot of effort that goes into making sure that kind of we're on side and dealing with the right people. And it mitigates the risk for everybody involved. And I think there's more and more people raising capital out there that are not doing it correctly. And I think it's just not good for the industry as a whole. And I don't want to be, on that side where we're getting in trouble. I'd rather just do, pay the money, hire the right people, do things properly. Does that mean that there's a lot of people that won't qualify for our deals? Yeah, 100%. Yeah, for sure. Like we are going to narrow the investor pool for sure. But at the end of the day, we're doing things right, and I can sleep at night.
Yeah, but the alternative is going with regular GVs. If you're not gonna have,
yeah, you can do that. I'd be careful with that kind of stuff. Like there's just too much going on right now about like just capital raising and such. Yeah, what's the line? So if I ask you the question, so what makes a JV partnership, legitimate?
Just the actual agreement, the GV partnership agreement, that's it, or having a shareholder agreement at corporation. So if you have a shareholder agreement with the GV partners, and
so I'm not a lawyer. That's why we hired a securities lawyer for this stuff. The line is very gray. Right. Having an agreement does not mean that you're on side. Right. I mean, this is, we can go into this honestly, like it's, I would encourage people just to kind of get proper legal advice. I think this, this idea that if you have, a JV kind of makes it okay. Maybe, I don't know, every deal is different, but I know recently, like look at Epic Alliance. I mean, Epic Alliance is a different thing. There's been other people that, recently, haven't been kind of doing it properly and have, gotten in trouble. And I just don't want to, I'd rather just err on the side of caution, invest more, more money in figuring out the right way, being above board. If it means that, some people can't partner with us, then that's, unfortunately that's, I think that's just the way we're going to operate.
Yeah, for the listeners, Epic Line issue was in Saskatchewan, I think. He had like $100 million of properties around Saskatchewan, and he got broke, and it was a mess.
Yeah, it was a mess. I mean, I only know really what I've read in the from the news sources, and
Yeah.
yeah, it's just, and I don't know, I don't know if that was I guess it was a securities. I guess part of it was a securities thing, but I think just the business operations in general weren't
Yeah.
sound to begin with, so that was probably the major problem. But when there's one issue, there's probably others, and I think that's what happened there. But who knows? I'm not an expert on it, but
Yeah.
I just know what I've read.
Yeah. So I think right now we have a good transition also on coaching. But before talking about the coaching program you have, is what was the influential mentor in your real estate career so far? And do you have still a coach in your career or not?
I'm currently not working with actually, sorry. So I'm not working with a business coach.
Yeah.
I did kind of sign on to a kind of a life coach at the beginning of the year. It's something that I always wanted to do, just more life in general, visioning and kind of just time and, not even balance, but just kind of life in general. That's super helpful. Right now, don't have a business coach, have used coaches before to train in terms of real estate. Right now, we know our plan, we're executing. We do, myself and my partner, we do provide coaching services for people coming into apartment buildings, especially, those that are in their first or second deal, even third deal. It's a transition, right? There's a lot of things to know, right? And I think there's a lot of mistakes to be made. We've made mistakes. And so, working with a coach just speeds up your transition into this space, which at first there's complexities, there's nuances, there's differences between, what we're doing and residential. And so to help people speed up their journey into multifamily, we help people do that one-on-one. We have some online training as well. So yeah, one-on-one or online. And, it's really focused on people kind of getting into their first or even second deal. Cause we've worked with people where their first deal didn't go so well, they've made mistakes and they don't want to make those mistakes again. And so they work with us. And I think the important thing, and there's coaches out there, there's, lots of different people coaching on different things. What I would say for those looking for coaching is one, are they active in the space that they're coaching in? Because I think there's a lot of people that are coaching that aren't really active and their main business is coaching. Cool. Our main business is buying apartment buildings and operating them. And so that's why we can provide, I think, that kind of value to people, because we're doing this every day. And we're like, especially right now in some of these closings that we're going on, we're on the phone with lenders daily. Things are changing daily. And so you don't really know that unless you're in the business, right? You're in it. So, that's the value we bring to the table. And, happy to work with people and kind of help them along their journey or kind of get started on their journey in apartment investing.
Yeah. Finally, I want to ask you about any book grabbed your attention lately on real estate, especially.
Real estate. To be honest, I haven't really picked up a real estate book in probably 6 months or so. I've been reading some other ones like Traction has been just kind of general business book. Who Not How is amazing. That's really good, I think, for people. Grant Cardone's 10X, I read that, maybe 8 months ago. That's good. A little bit of real estate in there. I think real estate stuff, if you're in Canada, I think, real estate investing in Canada, I think that's the title, Don Campbell, always kind of a rock solid book. Timeless, meaning that it was written, I think, probably 20 years ago or so, but still the concepts still apply. And that's just the concept of, some of the things, picking the markets, making sure that, you have population growth, just it's the fundamentals of real estate investing. I think that, if I wouldn't even say, it doesn't even have to be, you don't have to be Canadian for that. I mean, the concepts apply across the board. They're just sound principles for investing. So I would say that's one that I read early on. I still refer to it just kind of conceptually, but I believe it's called Real Estate Investing in Canada. Anyways, if you search Don Campbell, I mean, he's been around
his
for
early books.
Yeah.
I think more than 25 years.
Yeah.
Thanks a lot for your time today, and we're really happy to have you today with us. And I hope that we can bring you in again to the show.
Yeah, awesome. Thank you. Thanks, Adam, for having me on. As you can see, I love talking about this stuff. I'm passionate about it. It's kind of what I live and breathe every day, and it's so happy to connect with people. They can reach out to me wherever. Email Mark at Peak Multifamily, or on Instagram. Mark Baltazar, LinkedIn, Facebook, website peakmultifamily.ca. We're in all the platforms.
Thanks a lot. Thanks a lot.
Awesome.